People are nervous. It was a very difficult year in 2008. There was no 2018. There were virtually no place to hide in markets. And so what we are talking to them about today is that the impulse is to go to cash or to play it safe. We're advocating a different strategy for our clients, and we're suggesting more of a barbelled approach to how we're constructing portfolios today.
What do you mean?
Yeah, so if you think about it, within your, let's call it, take your equity portfolio. You want components which are really working for you. So you don't want anything which is just going to kind of go down the middle of the fairway. You want defensive components of your portfolio, things like minimum volatility. The quality style factor works very well in late stage cycles. But then on the other end of your barbell, you want things which could really pack a punch and have the potential to outperform should things go better, like emerging markets.
You're not talking about any cash necessarily.
Not necessarily. We're not talking about holding large cash balances here today.
And your thought with that is the market is looking at this as all risk to the downside, but you think there's still upside potential.
We absolutely do.
What makes you think that?
Well, what we're seeing, what we saw in 2018 was that the market reacted tremendously to geopolitical news surrounding trade. And so there are potential catalysts if we see the trade talks resolve between the U.S. and Canada. But also we see, and then that's why we see pockets of value in places like emerging markets. And while U.S. earnings are set to abate from their very, very high pace, of 24% to something closer to 8%, we still see value in certain segments of the equity markets.
We were just talking about earnings and profits really coming down. And while the consensus, the official consensus based on analyst estimates is still a little north of 7%, most people in the market think it's going to continue to come down based on what we hear from the likes of Apple, from Samsung, from
Right.
LG.
Right.
There are some people who even think we're going to be facing an earnings recession, that we'll see a decline in profits. Mm-hmm. What would happen to the markets if that were the actual scenario, or do you think that's been priced in?
Well, I think it's a risk, and I think one of the risks we need to focus on is that the consumer, while in the U.S. is very strong, internationally is not as strong. And when you look at S&P revenues, over 50% of them are derived from those international markets, and so it's something to be aware of. Having said that, a lot of that negative news has been priced in, and so we're really looking for it's going to be more of a selection and where you're placing your bets from a standpoint of what assets are you buying within the equity markets. Are you looking for minimum volatility strategies? Are you looking for certain sectors and placing your bets there, but not pulling out of equity markets?
Well, let me just ask you it differently then. In terms of in terms of the volatility that's going to happen this year, I know, but nobody wants to believe in market timing, but to some degree, you have to try to get in when things are lower.
Yes.
Did we just have that experience and it's over, or you think, given what you're talking about, you might as well sit with some cash for a while and wait?
Yeah, so that's actually a very relevant topic right now, and what we're talking to a lot of our family office clients now is look for those pockets of opportunity where things have declined in value tremendously. One of those we see is in the emerging markets, specifically in China, specifically in China A. One of the worst performing major market of 2018. And we think it has the potential to outperform.
What would you stay away from right now?
Europe would be an area where we think that the catalyst, there's no real catalyst to see outperformance, and it could underperform the U.S. should things continue to get worse.
Just the economic concerns, what we're seeing, the slowdown in China, what we're hearing about in other locations as a result of that, whether that's going to wash up on our shores. I mean, that's been a huge headwind for stocks.
Yes.
We got a little bit of that out of the way when we saw that stronger than expected jobs number, but jobs numbers are backwards looking. What numbers should we be watching here in the United States to judge what the economy is doing?
Right. At this point right now, all data is very important because we're at a point where we're at a difficult point. The Fed has said that they're going to be data dependent. The market is very focused on what the Fed is going to be doing. The market now expects the Fed to pause, no hikes for 2019, and so we're honestly looking at everything. We're looking at economic data. We're looking at data, out of the consumer, and we're listening to what CEOs and CFOs are saying about what they're seeing in their own companies for a glean of what's going on in the future.